Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Today, I'm joined by Tim Ivers, CEO, and Dan Nolan, Managing Director and Head of Origination at Warana Capital. Nice to see you both. Thank you for coming on the show.
Thanks for having us. Great to be here.
Hey, Todd, thanks for having us.
So, we've covered a lot of fund finance on this podcast, private credit, ABF, but fund finance has obviously come up a lot given its growth. And I think there were numbers recently putting the market well north of $1 trillion. You guys obviously play in the NAV lending space. Maybe give us a little bit of a market, kind of catch up as to where the most common use cases are for NAV today. Is it, liquidity, distributions, opportunistic investing, something else? Maybe give us a kind of where are we today with NAV lending?
Yeah, I guess when we've been doing this for 3 or 4 years now, and I think when we started, we thought the most common use case was going to be to fast track distributions. Like the theme was that DPI was a little behind schedule, and we thought that people were GPs were going to use their balance sheets or their funds to try to get a little bit of liquidity to then make boost their DPI numbers. Really what's happened is we really don't even get many requests for that at all. It's mostly been about opportunistic investing and mostly improving in existing investments. From what we try to do, we operate at more the smaller end of town in this market, so the sort of sub $50 million space, and we tend to favor transactions where the fund is pretty deep in its process, so 6, 7, 8 years into its life. So they don't tend to be doing brand new sort of opportunistic investing outside of portfolio companies. But what we've seen lately with the challenges of IPOing anything or M&A being a little tricky is that if a portfolio company is the third biggest in its space and needs to be the first or the second to really get any traction in the exit market, it might go out and seek to buy the fifth biggest company or the sixth biggest company and need a little money to do that. And the fund itself is maybe beyond its capital call period or doesn't really want to do that, or the number is quite small. So it tends to be more improve what you've already got, or maybe it's got 4 or 5 assets left and one of them struggling a little bit and has a debt situation coming up where it needs a capital injection to kind of fix that. So it's kind of using 4 quality assets to fix the fifth to make also that make it 5 quality assets. So it's really more about improving what you have in small scale rather than trying to add a new platform to a business or fast track DPI. It's kind of changed it, in more recent times.
And is the overall market, I know you said you guys play on the most smaller end, but would you say today's market is still, 90% done by the larger, biggest funds out there, or is there, is there a balance that has started to come to the market?
I think it's changing a little. Certainly, like if you look at my dollars, the big guys are definitely getting all the money. They're easier to bank from an underwriting perspective and
Yeah.
easier to bank in size. Like, I think doing any loan feels better when there's 10, 20 different portfolio companies underneath and it's diversified and you feel like not all of your eggs in one are in one basket. And in particular, if the fund's big, it tends to mean that those companies are companies that'll have earnings and some kind of floor value. So I think as a lender, if it's one of the mega funds, it's just easier to underwrite and so easier to extend credit to those types of situations. And so that means you're going to have the banks and a lot of the specialty sort of NAV lending providers favor that world. What I think's probably changed in the last few years, though, are the groups like us who are now more willing to go down and service sort of the middle market and the lower middle market sort of area of town, and that probably wasn't there. That probably wasn't there a year ago or 2 years ago in size, and so I think what you'll see in the next little while is more and more of those get done by number of trades. But I think any chart you're going to see is still going to be
Hmm.
heavily
Yeah.
dominated by dollars to the big end of town.
So you obviously you referenced the firm. Who is Warana? How big? And then I know you guys recently, Dan, you shared a white paper you guys did. Kind of what was the motivation behind the white paper? What was in it? What'd you guys cover in it?
Yeah, so from a firm perspective, we've been around doing this basically the same thing for about 15 years. So we cut our teeth and still are very active in the regular sort of secondary landscape, buying LP stakes. So that's a business we love and have had a lot of success in. And then really what happened with the NAV lending side is, 3 or 4 years ago, we started to see this sort of theme that's sort of coming through now of GPs starting to report that it's harder to exit things, runways on private equity funds continuing to extend. And what we thought we were going to do was, open up a business line that, to LPs that rather than them selling to us at some discount, that they might be willing to borrow against their LP stakes. And as a part of that, we started talking to some of the smaller GPs out there and saying, hey guys, if you ever have any LPs that are failing on a capital call or need some liquidity, please consider us. And they go, we'll keep that in mind. But actually, we have a situation in, our old fund two that, we need to fix, and we're out raising fund five, and it's, too small for any of the lenders we're talking to on fund five to worry about. So from a business perspective, it's sort of evolved into a space maybe we didn't initially appreciate. And what we're doing now is trying to fill that gap that the mainstream guys don't do. So that tends to be smaller end of town. We'll do deals from 2 to 50 million bucks, which tends to be a sort of an underserviced, part of the market. And then the other thing that we think that we can do, which is now a theme that's growing more broadly, is because we're used to more concentrated portfolios on the secondary side. We're used to having a fund that only has, one, two, three, or four assets
Hmm.
left. We're more willing to lend to that type of situation. Like basically the general thinking is if we were willing to buy a fund that's got three assets at 80 cents in the dollar, we're probably going to be great lending at it at 10 to 20 cents in the dollar. So whereas banks and others might come down with like a top down, we need to tick boxes on diversification and
Yeah.
other type of more broad risk metrics. We're more looking at what the assets are and what we think they're worth and it coming in at some discount to what we think we would otherwise buy them at. But Dan, maybe you want to cover the thoughts on what we were doing with the white paper.
Yeah, I mean, I think the white paper was really kind of driven by the fact that, like, when we looked at the market, we kind of saw there was this gap that existed, particularly around education, right? The fact that you could get smaller NAV loans. Like, people didn't really realize that you could get like a $40 million, $20 million facility. And, what we wanted to do was kind of put something out there and kind of create some kind of ability to breach the education gap that existed to say, that these facilities are available, they do exist, you can get them. And when you get them, oftentimes it's far more accretive to the portfolio than like selling at the wrong time or, trying to push through a CV that's not necessarily going to work. And, what we really wanted to do was really just kind of like put that out there and let people, I suppose, kind of find out for themselves that it's there.
So when we think about, NAV lending, obviously there's the traditional, as far as I understand it, was, certainly the private equity buyout fund. But obviously there's private credit today, there's infrastructure, there's tons of different strategies and types of funds out there. Is there a particular one that is best suited for NAV? Is it still the traditional buyout, or has the market evolved and the product evolved where, it kind of fits depending on what the needs of that fund or that GP might be?
Yeah, I think you can certainly do more things in terms of what's leverageable than what it was previously. I think the buyout stuff is still the most vanilla and the easiest thing to find a facility for, particularly the bigger things that have earnings. I think that in the next little while, there's going to be a big uptick in the number of the venture type world or the growth type world in terms of what you can do there. It is a really hard place to underwrite though, for obvious reasons, just in terms of like what's the downside case in some of those particular companies. But I think that those types of things, the availability of credit was maybe not there, 3 years ago. I think that's increasing. Infrastructure and real estate are interesting. Real estate is a little tricky because it tends to have already pretty significant leverage underneath. So,
Mm.
if all the assets in the portfolio are already at 60 and 70 LTVs, it gets a little bit messy putting a layer of, effectively what, on a
Yeah.
look-through basis is kind of mezz. So that can be harder to do and a little bit expensive. And then infrastructure is obviously a great case, usually very stable underneath. It's just how do you make a 3-year loan work on an asset that might have a 20-year duration? So like what's your takeout? And it never feels that great from a lender perspective to be the guys that are relying on a refi, I guess, to get taken out. So I think, all of this stuff is now doable where it wasn't maybe more doable, but like the private equity stuff is becoming, still the easier stuff to do. And then you've got the emergence now of like these private credit situations where,
Yep.
they've got their own liquidity constraints. We've seen all the press around the redemptions and the like, which may lead to more and more facilities in and around that type of stuff. I would generally imagine that there might be a more efficient way for those guys to find a leverage facility, maybe through securitization or something along those lines to find a source of capital. But we would expect going forward that, from our business perspective, we're going to do a lot more sort of loans to private credit funds to try to, help them with the short-term liquidity squeeze they've got themselves into.
I think we're seeing a lot more CVs now as well, like kind of
Oh yeah.
people coming out with CVs and doing NAV loans on the CV to try and optimize the cap stack. And it's just kind of evolving quite a lot now. There's an awful lot more that you could do with it than you could like 3 years ago.
I mean that brings me to an interesting question, which is like how much is changing real time from where like maybe what this traditionally has been thought of in a space, say 5 years ago compared to today. I mean, obviously you referenced all the bad headlines in private credit. Has there anything, materially changed on advance rates, covenants? Like underwriting, is that becoming, documentation becoming, loosening or tightening, especially given today's headlines? Like, how has some of this evolving in real time?
Yeah, I think it's starting to get more standardized, which I think is good. I think when we first felt like we were doing this, obviously every portfolio is different, but I felt like we would start with a blank piece of paper and you'd go back and forth with the borrower to try to optimize what you're trying to do, which was very time consuming and particularly annoying on smaller trades. Now I think because there's been so many of these things done, there's now more like a standardized, like this is like a core of what a normal deal looks like, and then you pick around the edges to kind of tailor it, which is, I think, dramatically better on an overall basis, just in terms of speed of execution. I think lawyers on both sides are kind of used to what each other's expectations are now versus before they might have jeweled it out. So yes, what we need from a security attachment perspective is now better understood by the borrower community, and so you don't get into those types of fights and all the rest of it. But in terms of the general terms, I think there's kind of been a narrowing in the sense that most things now are getting done at like 5 to 25% LTVs, and that's just becoming more and more expected. So you don't get as many requests from borrowers for like a 70% LTV that they thought maybe was more on the table beforehand. And then I think in terms of general terms, like maintenance, covenants, all this type of stuff are in and around cash sweeps are just becoming more standardized for a base deal, which I think makes the whole thing go faster. And I think it'll make it grow because if I'm a borrower sitting there going, what might this look like for me? They can go to an advisor now or even their lawyer and say, this, what would it be? And they can give them a pretty good sense of what that might be rather than having an iterative process with us where we're spending a lot of time to try to work that out.
I mean, we'll get to the LP part in a second, but GPs, are they becoming better educated? Obviously, Dan, you referenced it around the white paper, but and do you think that we are moving towards an iteration of the product that might suit, younger, less advanced funds at some point in the future?
Dan, you want to cover that one?
Yeah, I mean, I think that we certainly are, and GPs have become far more educated and everything, and kind of to what's available to them, really. Like, if you look at it a few years ago, people like really focused on sublines, NAV loans or something for much bigger funds. And I think now, as we're going on, we're seeing younger sponsors coming and looking for NAV lines on, first or second time funds and trying to attach different things, be it management fees or, the portfolio that's already in the ground or uncalled, and really trying to structure something that's relatively unique. And I think that as time goes on, that's going to become more standardized. But at the moment, we're kind of like going through that phase where people are realizing the options that are available to them.
So a lot of the these headlines around NAV has certainly centered on the LP, and I had ILPA on this show. It was probably mid-year last year, and we talked certainly a lot about it, and they had put out some guidance around it. How have you seen the LP education around NAV lending and NAV financing evolve, and especially with a product like yours, which is obviously a little bit more on the smaller end? Has that, what does that evolution look like in terms of the limited partners?
Yeah, I mean, I think it really depends like massively on the type of LP. So like larger pensions, sovereigns, they kind of want to understand the tool, its uses, the benefits of it. And like ILP has been fantastic in that and kind of like educating people and letting them know like what they need to understand. I think smaller LPs are catching up. But I think it's been difficult for some of the smaller LPs, like as like to what we pointed out before, like there's been some negative press around the use of NAV loans over the years, and I think smaller LPs sometimes kind of get caught on that a little bit. But like I think in terms of like for any LP, the most legitimate concern has to be like, what is the use of proceeds? Is it accretive to the portfolio? What are we going to do with this? So I think everybody's getting themselves to the point where they're getting more educated on it and trying to understand it better. But like most importantly, like what is it for? And is it the right size? And how's this going to kind of work? And I think for an awful lot of groups, what's been helpful has been that GPs are now going to LPACs before trying to run a process or trying to getting halfway down the road and then saying, oh, I better go talk to my LPAC about it. They're kind of front running it with them now, getting everybody on board, and then it makes everything much easier from everyone's point of view. Like we had a couple of years ago where, just the LPAC just wasn't informed, and kind of when it all came out, it really wasn't great.
I mean, it is some of this like going in documentation and the transparency essentially, like from the beginning, the LPs are like, all right, because it seems like sublines, that's become standard. Like, with I think Ilpo referenced 95% of funds use it now, but obviously NAV is a bit different, and there's all these other funky things that are also coming out. But are you starting to see that more in documentation and across the board with LPs?
Yeah, we're certainly starting to see LPs understanding it a lot more, and for it to be included in the documentation of the fund, the ability to do this. I think kind of one of the things that like kind of LPs are trying to understand is just, what is it relative to a subline? Like to your point, sublines become normalized now, but kind of, understanding a NAV facility and kind of that sometimes there's this thought that it's like a hidden leverage trap when, really that's probably overblown because they're very conservative relative to like, kind of the asset base that they're on. So from that perspective, I do think that like as we've kind of gone on, it's gone into documentation, GPs are more willing to speak about it. There's more transparency about it, so it makes it much easier for everybody to have a proper and kind of transparent conversation about it.
And I think back to the question around standardization and everything growing, I think this has been an important reason why I think we're going to see more of it. Like 3 years ago, it might not have been in the LPA that you could do this. It might not say that you can't do it, but it was kind of
Yeah.
blank. And that made it kind of tricky, even as the lender, because A, you wanted to make sure everyone was aware of it and the LPAC and all the stuff that Dan's talking about. But from an attachment perspective, it could have led to, in terms of what types of things you're getting pledged and not, it became, it becomes a little tricky when you don't have an explicit approval to be going and doing what you're doing. So from our side, we love now that you're starting to see it in more LPAs, but also discussed how they might use it and caps on size and what it might lead to from a risk perspective and all that different type of stuff. So, if we turn up to a situation and the LPA is already flagged that they might take a NAV loan out for portfolio investment purposes at a maximum 15% LTV, and it might result in, the pledge of certain assets. Yeah, that feels like a better situation for us to run at with, frankly, tighter pricing than a situation where it's blank and we go, oh, this is going to be a mess. We might have to go with wider pricing because we're not going to get perfected security. We might have to be sitting there going, the LP might not be expecting to see it. So it just becomes a little bit more of a messy trade, which probably leads to a worse outcome that takes longer.
If we look at, kind of where the fund finance market is heading, obviously the lender landscape has evolved, pretty dramatically from just banks or pretty concentrated in larger banks to folks like you and obviously smaller banks playing in the market. I mean, um, one question I always have is, funds lending to other funds, how, complicated can that get? If ultimately you're lending to someone who, conceivably might look similar size and scope as you, how do you deal with some of those things that ultimately might come up, when doing some of these transactions?
Like, it's been great actually. Like, these products are vanilla from a top-down perspective in the sense of what they're trying to do and the purpose and like the general concept of what they are, but the actual documentation and how it's all going to work can get pretty sophisticated. Everyone's structure chart is different, and I'd encourage you to go look at any private equity web diagram. Like, it's incredibly complicated as to how these guys are using blockers and all these different underlying structures to optimize outcomes for LPs. So it's kind of good having someone who's sophisticated on the other side and who understands the types of issues that you're facing, both from the diligence materials you need and then what you're going to need to attach. Like, if you're dealing with a GP, they're going to understand how risk works and how, if we don't get a particular pledge or piece of security, that is going to impact how we think about risk. And if that's the case, that might impact price. Like, when you've got someone across the table who is sophisticated and across those types of things, it becomes much easier to do. If it was a group that is not as deep into the weeds of their own structures and or is not as sophisticated in thinking about how to think about risk and all the rest of it, that can become very challenging because you're not on the same page when you're trying to negotiate the minutiae of the details of the deal. So it's not I'd say it's a good thing for the industry that you've kind of got two GPs facing each other because it can make it, cleaner and easier to do something that works for both parties.
Earlier, you've referenced, secondaries, obviously, and you referenced continuation vehicles. How are those starting to even converge more? You're starting to see more deals on both of those, and what about the LP side? Are LPs starting to do NAV, take out NAV loans, and what does that look like? Because I've heard that. I've talked to a few, but curious if you're starting to see a little bit more of that as well.
Yeah, I mean, we're certainly seeing more LPs coming and looking for NAV loans, and kind of if you kind of, I suppose, look at the broader market, like an awful lot of LPs who don't fit within certain bands for private banks are relatively underserved in the market. So a product like ours appeals to them because they don't necessarily want to sell; they just have a liquidity need, and they're trying to solve for that in the short term.
Yeah.
And what we've done a couple of times now has been for groups like this that they don't like what they really just have is like a liquidity shortfall for a set period of time, but they need like a bridge to liquidity facility because they've got a monetization event that they know is coming down the pipe, but right now they need the cash. So it could be relatively short term. And that's where we've been pretty flexible with groups like this. We're able to do these short term facilities and kind of bridge them till they get to the next point.
And if you think through the security for that, so why that's an interesting development in the market and where it could be interesting going forward is like historically, if you're a bank in the NAV lending market, you would prefer to own a private equity fund because you are then going to own 87% of a portfolio company underneath, and that tends to be a very similar type of risk exposure to what they're accustomed to when they're doing bilateral loans to companies.
Mhm.
Where it gets tricky for them is with these LP loans because the underlying collateral is an LP stake in a fund where you're going to need the GP approval of that fund to transfer it to you. And from what we understand in terms of how that works, it tends to be bad from an internal capital perspective in terms of how they deal with their regulatory ratios. So if
Mm.
that borrower was to default, it can be a bit of a yucky thing for them to own on the other side. So why we're excited about that part of the market is it probably needs more of the private credit sort of guys to be able to fill this type of LP void that's coming in. And then in terms of where we think it's going to go, like our sense from talking to GPs and other LPs out there is that when people were making private equity commitments 2, 3, 4 years ago, they're anticipating liquidity coming from their existing stuff when they were planning all of their future calls. And so you've got this dynamic at the moment where funds are way behind schedule in terms of DPI, which is going to impact that type of budgeting that people have done. And so we're expecting to start seeing more and more need for these bridging solutions that Dan's talking about just to make their capital call profile work. And maybe it gets worse. Like we've funded a loan recently that was against a capital call default, where great borrower in the sense of like a very sophisticated group, but just had anticipated more liquidity coming out of the left hand to be able to fund the right hand. And so it's about being able to, I think the NAV lending market's going to step into those types of things to try to shore up those near-term sort of bridge solutions that need to happen.
What if we get to a point where it's like, I guess the way I envision it, like super unbalanced, or just
Yeah.
like the exit environment continues to drag and slow. It's like, do you get to this point where it's like, how much bridging and how much can some of these firms do where ultimately it gets to a point of like, does it hit to a head in the road? Like what happens?
Yeah, I think that's a good question. I don't know if you could predict that at the moment, and particularly with some of the macro stuff going around. I think from a
Yeah,
NAV industry perspective, like the lending industry, like with LTVs down in the fives, tens, 15s, and 20s, like how it typically works for us is we might have 4 or 5 assets in a portfolio, and realistically, with the cash sweep and the LTV, like they only need to sell one of those companies for our loan to be repaid. So
got it.
most of our loans on the NAV side are giving a fund 3 years to sell one asset out of 5. And while it might be challenging them for them to sell all 5, I don't think that's going to necessarily impact the NAV lending market too much. Certainly, it's going to be an increasing problem for LPs that are expecting to get all their capital back from various different things, and we're expecting continuation vehicles and all this type of stuff to continue to be much bigger things over time as GPs look for creative ways to get cash back into the hands of people that need it. But yeah, we're very bullish in the sense of where we think NAV lending is going to go, but we're also equally bullish that on the secondary side of our business, that is not going away anytime soon with people needing to manage their own liquidity needs.
Is there anything, either structurally or regulatory wise that you could see that would really slow this market down? It feels like it has some pretty good growth prospects to it, but do you see like I know obviously regulators and legislators are looking at private credit and private markets a bit more closely these days, given some of the headlines, but is there anything that's you can see? We can't predict regulators' behavior in the future,
Yeah.
but either structurally or regulatory that you might be wary of at this point?
Not so much. Like I think it's obviously very unpredictable and so hard to know. I think with the growing trend that's already happening where funds when they get created are kind of already building in flexibility in their disclosure materials to have this kind of ready to go. I think that's only going to help that dynamic. Like I guess you could see a situation where there'd be more regulations and focus on funds that hadn't necessarily disclosed this back in the day. But I think that naturally where the NAV lending market's going is these loans tend to be pretty low LTVs. So like I think if you started to see the market, do 50 and 60% LTVs and portfolios start defaulting and portfolios start getting taken away from LPs, that's where you'd expect maybe regulators to step in. But we're not currently seeing a situation where there's movement amongst our peers to go and over lever some of these situations such that you're going to see these widespread defaults and things like that that might sort of get that type of attention drawn on the space. So far, so I think it's okay. I think it's a very, it's a sophisticated party lending to a sophisticated party. So, I think a lot of the other hot buttons that might be a focus for the regulators are maybe not as prevalent versus some of the other things that are going on out there.
A couple more questions before we get to a couple of fun questions and wrap up. Is there anything you think's being overhyped in NAV lending right now? And then on the flip side, is there anything that's underappreciated about the market?
Dan, that's a good one for you.
I think overhyped. I think sometimes there's this thought that like that kind of NAV facilities are like a DPI machine rather than like a financing tool. Like they don't generate alpha. They're there to help the portfolio manager achieve their goals and to do what they need to do with the portfolio in order to realize the assets. And but it's not a situation whereby if you just put a NAV loan on it, DPI is automatically going to be enhanced for the LPs. So I think that gets overhyped sometimes in the press. And then I think the other thing in the press is probably the narrative that, the market is like one bad loan away from blowing up. Like I've heard that a bunch of different times, like particularly at conferences or kind of read it in different media pieces, like, oh, one of these blows up, the whole thing is gone. And I just don't think that's, the case. And I think the structures are conservative and recoveries will be high and defaults thus far have been minimal. So all of that needs to be taken into account, but sometimes it's just not necessarily the way it gets presented, particularly to LPs.
And then on the underappreciated side, I think there's part of the reason we did the white paper we were talking about is to try to educate what's out there at the moment. I think there's an underappreciation as what you could borrow against at the moment. So, um, you know, like the example I gave before, where one of the investors, an LP in a fund failed on a capital call, but the GP didn't want to use its default powers. Like there is an ability to move quickly to get that financed, such that the LP doesn't get zeroed, and the GP doesn't have to tell their subline provider that they've got a defaulting LP and or ruin a relationship with an important investor. So,
Yeah.
it's those types of things where maybe the IR team at a big firm didn't really appreciate that there was something, that there's something to do to kind of fix those types of problems. And likewise, on the LP community, there's a growing breadth of different things you can borrow against. Like you can borrow against your LP stakes. Maybe there's some investment properties you want to add into the mix. Like, the collateral that is serviceable for a loan in this market is getting wider. And so, it's more about trying to, educate people that, there's no silly question in terms of like, I need $10 million to go and fund this capital call on this side, and this is what I have on the other side. Can you help me? Like, that's not a silly question in terms of what's out there in the market. Whereas maybe 3 years ago, everyone would be like, oh, that's too hard, too complicated, too gnarly.
If you had one piece of advice to give to a GP considering NAV financing for the first time, what would it be?
Or, so I think it may be two things. So like firstly, the first thing is to make sure that the LPs are happy with the concept and or you're allowed to do it. Like there's no point in going and engaging the market and then working out that your largest LP is completely against it, and be thoughtful in and around what you're going to be using your proceeds for, and be able to tell the right story that it's better for everyone, not just you using money to put into an asset that's good money after bad. I think it's so long as it's well thought through as to how they're doing it, it's usually we've seen it pretty well received in that community. And then the other thing is to be organized. From our side of the fence, the number of times that we have an initial call with someone and they explain the situation and we get a general sense, and we'll provide some general terms of what it is. And then we start digging into the DD, and in actual fact, the ownership percentage of a particular company is less, or we can't, there's actually more leverage in the system. Like from a lender's perspective, that tends to start feeling like the story's not adding up and can lead to expansion of terms and it being more expensive. Like it's so much easier to get better terms on the front end. If you can turn up with a data room that has all of the information, you'll get more traction in the community from groups like ourselves bidding against each other when you see something is clean and well thought through versus, oh boy, this thing's going to have some worms on it. I need to sort of budget for those worms coming down the track.
I think another thing I'd
Yep.
say is, if you're a GB and you're looking at it and it's like your first time doing this, like consider how you're going to go to market to do it. Like, are you going to hire an advisor and, are you going to run a process and what's that going to look like and what are you trying to achieve through that? And then kind of like have all your goals lined up before you actually make any decisions around that. And then once you actually do that, kind of a lot of processes get run in a lot of different ways, but we've seen processes where, kind of a lender gets picked because they have like a very low price and then they just can't come through with the loan and the whole thing falls apart and then the whole thing has to
Yeah.
get run over again. And, frankly, we've been, the beneficiary of that in multiple cases where, you know, groups have come in and just can't stand over what they say they'll do. So I think my advice to somebody if they're doing this would be like, make sure that you have your ducks in a row in terms of like choosing an advisor, choose the right advisor. And then when you do that, like talk to the advisor about all the different factors that go into this beyond just the price.
So we have just a few minutes left here. Some fun, lighter questions to end us up here. So, Dan, I'll go to you first.
Okay.
Do you have a favorite sports team and or hobby?
So I think my hobby these days is actually ferrying my kids to their hobbies. So I think
I
that
know how
could
that
be my
feels.
hobby at this point, yeah. But I'm a big rugby fan, so whenever I get to go see a Leinster or an Ireland match, that's always a good day out for me.
Tim, what about you?
Well, so I'm from Australia originally, so I love rugby, cricket, all that type of stuff. Although now that I have to talk to Dan all the time and Ireland's become better than Australia at rugby, that's becoming increasingly more difficult to swallow. But yeah, I've been in the States for 10 years now and I've been surprised at I love NFL. So been out here in LA for 5 years now, and so we're season ticket holders of the Chargers and got an 8-year-old boy
Nice.
who's massively into it, and it's I think it's just one of the great global sporting products. I know they got a game in Australia this year, and the
Yep.
stories that I'm hearing from people trying to get tickets down there, it's going to be very, very well supported. It's I think it's just the best and most interesting sport to watch, and maybe one of the only ones where you can kind of get anyone who's vaguely interested in sport, whether that's your wife or friends who don't know anything about the game. Like I'll bring Australian guys to go over and watch a game, and they just eat it up. I think it's a great thing.
One surprising thing about yourself, Tim.
Well, maybe to extend that, I'm massively into fantasy football off the back of my love of so I'm in many leagues, but maybe the surprising piece about that is, all the leagues I'm in with American guys are great, but I've got this league that we've been running with Australian guys, so only Australian guys, and we've been going for the last 10 years or so. And I would say that the Aussie guys have a deeper knowledge base about teams than many of the
Wow.
US guys. Like the guys in Australia can tell you the fourth string cornerback for the Seattle Seahawks type stuff, even like at this time of year. So the Aussie
The
guys are
US
massive.
guys probably think they know it, assume that they know it, and the Australian guys actually do the research.
They will spend the time. They'll be able to tell you the guy's stats and why like it's a great matchup for the third string Jacksonville wide receiver this week. That type of analysis. So I love it. It's great. We've always do the draft in Australia, but for this year we're going to do the first year. We're going to bring all the guys over here. It's going to be fun.
Dan, what about you?
I guess from a work perspective, it would probably be that I really enjoy like the deals that are slow burns. Like kind of my most of my job is like building relationships with people. So it's like it kind of as you build a relationship, you expand your network, you try to solve the problems. So like I actually really oddly tend to like the deals where the first meeting was like 18 or 24 months ago and it comes back around multiple times and eventually you get it done. Rather than finding it frustrating, there's kind of like a I don't know, a sense of comfort
Sport.
in the whole thing. Yeah.
Yeah.
One book that you guys recommend reading. Dan, you first.
I think the one I always go back to, and it's on my phone, so whenever I'm on a plane and I get delayed and I don't have anything to read, I go back to it, is When Genius Failed by Lowenstein. And it's just like, I love anything that's about like the danger of hubris and the importance of skepticism. So that's kind of right up my street.
Yeah, I'm not much of a reader, to be honest. I like a lot of the nonfiction type stuff. So like Shoe Dog and all those types of things, I eat up. I'm reading 1929 at the moment, which is obviously a little dark in light of the world and all the rest of it. But that type of stuff and trying to, people being able to turn otherwise boring stories about like the financial market crash in 1929 into something where you can kind of buy into the personalities and try to understand things from their perspective, I think are great reads. But yeah, not much on the reading side.
Most exciting part of your job, Tim?
Uh, every day is different, and we're underwriting a different piece of security, a different type of asset nearly every day. So like that is just fun, as well as like dealing with some of these great GPs that have built these awesome companies and businesses. Like we've got a great fun team at Warana that are really fun to work with. And so when you get two or three, team members together to go and work out what we're going to think about a widget manufacturer in the middle part of the US, like that type of stuff is fun. And then the next day you're looking at a toll road in Virginia or something like that. Like it's just the diversity of stuff just makes it easy to come to the office. You're not on one project grinding away, for 12 months at a time and hoping that it goes through. It's every day's a new one.
Dan, I think your answer probably clarifies that
Yeah.
the most exciting part as well, the slow burn piece. But I'll ask one prediction for the next 12 months. First Dan, and then Tim, you can wrap us up.
Okay, I think continuation vehicles and NAV financing are going to kind of, the coverage of the two of them, particularly in the advisory side, are going to converge into one product. And that, like, a lot of the advisors are going to start to present that to sponsors as kind of a single solution with two different paths. Because, kind of what we're seeing at the moment now is like groups that either cover one but don't cover the other, and they're kind of missing out on it. So from what I can see, like the groups that are really doing well at taking this to sponsors and trying to find solutions are the ones who are going with both options.
I think it's one of the hardest times to try to predict anything, anything at the moment. I think that if I was going to say, stuff that's more related to us, like I think that our mix of asks on the NAV lending side is going to get more prevalent on the LP side than what we've seen historically. I think we're going to start seeing that theme that I was mentioning before about, LPs being finding themselves in a bit of a bind in terms of some of the commitments they've made as managers call down capital. They don't necessarily have the DPI from their L1s to fund it. So I'm expecting to see a bit of a change, at least in the number of asks we're getting on that side. Whether we can actually do them or not, maybe is a different thing. So maybe that doesn't come through in the overall stats. But I'm with Dan. Like the NAV lending space is going to be, I don't know what the right number is, but it's going to be 50% bigger, in very near term, and probably 50% bigger again pretty soon after that. Like it's, there's just too much money going into these things and stuck behind the scenes to not have these types of solutions to try to fix things.
I think that's a perfect place to end it. Tim, Dan, thank you very much. Really appreciate your time. To the audience, we will link to the white paper in the show notes, so look out for that. Appreciate your time, guys. Really enjoyed this.
Thanks, Todd.
Thank you very much.
Thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.